Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's February 1st of 2019, episode number 13. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we're excited to have Erik Townsend of Macro Voices fame join us. Erik is usually sitting on the other side of the interview booth, so we're excited to have him switch roles while we ask him what he thinks about the markets. He'll be joining us shortly, but in the meantime, Patrick and I have a few announcements.
Now, this show is broadcast as both a podcast and on YouTube. So if you're enjoying this as a podcast and feel like you're missing out on the charts and videos that we're referencing, you can register at the markethuddle.com website and get the weekly email, which includes the chart pack and the video links, or just flip over to YouTube. In this week's episode, we discussed the dollar gold pair trade with Erik, and we get him to share a tale from the trading desk. Afterwards, we're going to get into the epic cave by the Fed.
In our This Week in Trading History segment, we take you back to 1997 when the Fed auctioned off their first inflation-linked securities. And for the WTF clip of the week, Jay Powell gives Trump what he wants, more cowbell. And we end with the most 5 important things to watch next week.
Kev, let's jump right into it.
All right, Patrick, who's the show brought to you by this week?
I reached out to Flying Monkeys Craft Brewery. We've had a number of beers from them, but they were sponsoring the FOMC press conference. And I said, you got to send us the beer that Powell was drinking before that press conference. And so they sent us the Smash Bomb Atomic IPA. And now this is a strong beer. It's a 6% beer. So let me read this. It goes, the description is, this is not a test. Smash Bomb Atomic IPA flares with flavor from the bizarre citra hops brewed with a strong crystal malt backbone. The fiery, bold body of this ale positively radiates its own energy. And then they give a warning that this rich, flavorful IPA ruins you for lamer beers. So
how many do you think Powell had before his conference?
Oh, he had to have at least 2 of these because otherwise he would have been stumbling into the room. Let's see what the heck we have here.
Okay, let's see. What do you think, Patrick?
It's definitely very strong. It's not as hoppy as I would have thought it would have been. But it's got a strong, rich taste. There's no doubt about this. I'm not going to say it's bad, but no.
That's going to be a plus because usually
that's a plus. That's a plus. No, listen, I don't know if this is like going to be a normal beer I drink, but I certainly would say that this isn't bad. It's good. It's good. It's good.
Now,
it's good. Let's just call it good.
New listeners, that is about as much of endorsement as Patrick ever gives to our sponsors. Okay, so I need to do a little bit of illegal stuff here. So here we go.
Do your thing, man.
Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much market huddle may include inability to breathe, temporary tooth loss, appearance of extra digits on hands and or feet, fervent punctuality, and inner ear euphoria.
Are you drunk already?
Yeah, so I gotta laugh. Okay, let's get going.
Okay, let's get to this. All right. So
let's invite. Sorry, you go ahead, Patrick.
Yeah. Let's invite Erik into the call here. Hold on. Now, joining us for this part of the podcast is Erik Townsend, the host and my co-host in Macro Voices. And Erik, welcome to the show.
Thanks for having me on, guys.
So, Erik, we wanted to bring you on to just shoot the shit about the markets, and particularly what you thought was one of the more important things to talk about in the markets. And you shared with us, we talked about actually when the three of us were on Macro Voices yesterday, and we were talking about the putting on the gold and dollars pair trade. So why don't you share with us what's on your mind in terms of that pairing?
Sure, I think this is a really, really important trade, and I have a hunch that it's going to work, but I want to emphasize it's a hunch, and when you have a hunch in finance, you got to verify it by actually doing the research, which a lot of people, frankly, don't do. So let me explain the whole thesis for why I think this is a good idea. And I think regular listeners probably are familiar with people like Brent Johnson and Luke Groman, two super duper smart guys who couldn't possibly disagree more with each other. But at the end of the day, they don't really disagree that much. They disagree dramatically about the timing and the sequence of what happens. Both of them sees gold going to the moon before this is over. And when I say this, I really mean the unwind of whatever happens next as we find out what the real price to be paid is for all of the central bank largesse of the last decade. How long does it take for that to play out? Nobody knows. But whenever it does, eventually, I think all the smart guys in the room know that gold is going to the moon. The thing is that if Brent is right, then what happens is the dollar index is really going to dramatically appreciate in kind of one last final hurrah. And that could squash gold. That could push gold down well below $1,000. You can't go too much far. You can't go too much farther than $1,000 to the downside, because if you do, you get to a cash cost of production scenario where all of the mines go offline, and it really provides a price support. But you could get down to $800, maybe even $750, if Brent is right about what happens to the US dollar. But at the same time, you can't afford not to want to be long gold here, because if Luke is right, then the dollar is about to collapse and gold is going to the moon, not in 5 years, but in 5 days it could be starting. And Luke hasn't predicted 5 days, but the point is it could be any time now. So what do? Is there a way to put on a trade where the trade actually profits if either one of those guys is right? And the reason I think there is such a trade is, even though gold and the US dollar normally trade inversely correlated to one another, so gold goes up, dollar goes down, dollar goes up, gold goes down. What we've been seeing, and this is something Raoul Paul and I and several other people have been predicting for years, and frankly, we were early in this prediction because I thought it was going to start a couple of years ago and it didn't, is where gold and the dollar both find a component of their trading, which is a safe haven trade, that allows them to both outperform each other, so that inverse correlation is now to the point where maybe eventually both gold and the dollar start rising together at the same time, very much inconsistent with their historical inverse correlation. Now, they don't have to both be actually rising at the same time. If one of them is rising very quickly and the other one is going down, but only going down a little bit compared to how the other one is going up, then that pairs trade, if you get the ratios right between them, where you're long gold and long the dollar at the same time, one of them's losing money, one of them's making money. But I think there's a pretty good bet that whichever way it goes, the one that's making money is making more money than the one that's losing money. But now you're playing a pretty sophisticated game of hedging ratios in terms of how much long exposure you have to gold and how much you have to the dollar. And if you're off by just a little bit, then what could happen is you're right about the concept of the trade, but let's say you're a little bit too gold heavy and Brent turns out to be proven right. You've got that dollar index exposure in order to give you the upside if Brent is right. If you had a different ratio, it would have worked, but at the ratio that you chose, you ended up losing money because your long on gold was losing more money than your long on the dollar was making. So it's not a simple question to say, what is that ratio? It's not as simple as just equal dollar, notional matching. It's not like that. And I don't know really what the best way to go about this is. Regression analysis is one approach. There are probably other approaches. How do you really figure out what the right weighting is, so that regardless of whether Luke is right or Brent is right about what happens economically, the pairs trade still produces a positive result either way? I believe it's possible, but frankly, I'll admit, I don't know exactly how to calculate that ratio to really get that balance right. And that's what I hope you guys would have some ideas on.
One of the things that a lot of traders do is they look at the gold not just priced in US dollars, and then you can see from this first chart, we pulled it up here. You can see that that's a chart of gold in US dollars, but they also look at it priced in euros or Japanese yen, which is our next chart. And you can see that it's rising in Japanese yen term, and the final chart is the euros, and you can see that this chart looks fantastic. So that's kind of the most simple way that guys can do it. Like you just go out and you just buy gold priced in another, denominated in another currency. But you're talking about something more sophisticated than that, obviously.
Oh, absolutely. I'm talking about a pairs trade that is going to produce a profit if Luke is right and the dollar crashes and gold goes to the moon, it profits. But that same trade with the same position sizes also profits if Brent is right and the dollar index goes to the moon first and gold is weak initially.
Well, I can tell you how I would do it. For me, I would look at the regression analysis, and I would pull up we're going to use ETFs just so that people at home that want to trade this from an ETF perspective can do it. This is the regression analysis of UUP, which is the dollar index, versus the gold price. And you'll see that, as Erik mentioned, it's negatively correlated, and you can come up with basically a hedging ratio, which is the beta of this kind of regression analysis. You'll also see that recently we've had kind of a big move, and this is what you and I talked about on Macro Voices, Erik, was that gold seems to be outperforming the dollar recently. And you'll see that you can kind of notice from where the level is, that one little dot that shows the latest level, you can see that it's kind of jumped out of the recent kind of past and is actually not where the red line is. And if we plot this chart, we plot kind of the regression analysis spread, which is the next chart. You'll see that this is actually rising, and this is what we're doing. So for me, that's one approach that I would look at it and take, is that I would just kind of.
So just to be clear for our listeners, what is the actual weighting ratio that this suggests here? That's the raw beta, right?
Right. So that would imply that for every share of GLD, you would do 0.148 of UUP. And that is what you're looking at.
Okay.
And that's the raw beta. And the kind of the key there is that it's looking at the historical past and saying, what has it moved like in the past, and what was the relationship when gold moved? What did UUP do? And if we therefore think that one's going to outperform, and to me, I kind of view it as, I think about it as gold will outperform the equivalent UUP position. That's how I think about it. And when I look at that chart, I say that it's already happening. When you look at the next chart, you'll see that the spread's actually moving up. And the one thing is that it has been higher in the past, but this is the recent, past. But the kind of the trick to this is, when you go look at that regression analysis, I did the regression analysis for the past couple of years, but if you go past kind of 3 years, 4 years, 5 years, that's always changing. And that's a difficult portion of, and that's kind of the art that Erik's talking about in terms of deciding what is that kind of slope of that relationship and how do you get it right. Now, that's how I would do it. Erik, Patrick, you have another way that you were talking about.
And this is where I look at things a little bit differently, because to me, it's just about, look, I want to be long gold and I want to be long the dollar. And essentially, if this natural intermarket relationship remains the same, where the dollar is up, gold is down, or gold is up and the dollar's down, that they're moving inversely, that more or less one is doing a good job at hedging the other based upon past intermarket relationships. And if Erik's scenario, where gold and dollar start to rise together, well, you're long both of them, and suddenly you've been hedged if the intermarket stays the same, but you're now making a ton of money if they start moving together. So to me, I always look at things from a volatility adjusted basis. So what I did over here was I took the implied volatilities of the GLD, and this again just to kind of use a share weighting. Obviously you could do this in the futures market with the same ratio, and so on the GLD or the gold ETF, you've got an implied range of or implied volatility of about 9.1%, And when we look at the US dollar index using the UUP as its benchmark or proxy, you're talking an implied volatility of 6.8%. And so saying that we're buying roughly about $100,000 of gold exposure, so we buy 800 shares of the GLD at the underlying price of $124.50. That's a $99,600 exposure. Now, to buy the equivalent $99,600 of exposure of the UUP, you're talking about buying 3,922 shares. But it's a much lower volatility, so you're not actually getting a clean hedge, because one is the gold is more volatile than the dollar. So if you vol adjust, you roll up your UUP position to volatility adjust the fact that it's a lower vol, then the ratio is about 1.34 or so. So you're talking about, in this situation, buying about 5,255 shares of the UUP for every 800 shares of the GLD, or you're grossing up about $35,000 more of dollar exposure over that of gold. And that would, to me, create a constant volatility to the sizing.
You know what's interesting about that, Patrick, is you're not that far off my number.
Right.
The ratios are pretty close.
Because if you take, you're talking about the ratio of 800 shares against 5,200 type of thing.
That's right. That's correct.
That's about 0.15. That's it. Let me go. That's the raw beta that you have a 0.1.
Yeah, you know, when you said 0.148, I think you might have misspoke, Kev, because I'm pretty sure that you said 0.148 shares of UUP for one share of gold, and I think you meant the opposite of 0.148 shares of GLD for one share of UUP.
You're absolutely correct, Pat. I mean, Eric, you're absolutely right. I got the backwards. But and you know what's interesting about this is that Patrick's way is how Ray Dalio at Bridgewater, that's the whole basis of risk parity.
Right.
In terms of
volatility, constant volatility.
That's right. Adjusting your portfolio, not based upon a regression analysis, but based upon the volatility of that security. So, Eric, we gave you a couple ideas. What's your thoughts about how you're going to kind of try to structure this trade and what you're thinking going forward?
Well, the problem I have with this is that you could get really sophisticated here, and frankly, I don't have the resources to do that. So if I had, hypothetically, a staff of minions, a research department that I could task with this, what I would say is, look, we need to look not just at what ratios we're seeing, or even, you know, the broad sweeping regression analysis that you're doing over a long period of time. That ignores the scenario where there may be different relationships that tend to be in play during uptrends and downtrends in each of the individual components. So I would be looking at, okay, what are the periods of history where the dollar was trending upward? In those periods, what's the correlation with gold? In the periods when the dollar is trending downward, what's the correlation with gold? And I would be thinking about designing this trade not only in terms of calculating the ideal ratio, but also how to potentially adjust that ratio over time. And I would be thinking about stops, not just on price level, but if what you're counting on here is we're really saying that something funny is going on, where, you know, gold and the dollar usually trade in an inverse price relationship. But right now we're seeing this outperformance where they're both kind of skewed to the upside, where you would think based on the dollar performance that gold would be lower than it is, it's really higher. When you think based on the gold performance that the dollar would be lower than it is, it's really higher. So if you know that that's what's making this work, you want to watch for when that stops being true, and you want to monitor those correlations on some kind of trailing average system, so that as the correlations start to break down because something has fundamentally changed in the economics, it's time to take that trade off, or perhaps it's time to change the ratios. So I think you could get incredibly sophisticated and eventually get to computerized models that constantly maintain a long gold and long dollar exposure, but they're dynamically adjusting their position sizes based on how the correlations evolve over time. There's almost no limit to how sophisticated you could get. And my point really is, I don't have the research staff to do all of that. I've got you guys on a podcast, and I think I think we should probably make a point for listeners, which is you don't have to be perfect here. If you've got some gold in your portfolio and you also have some dollar, if you believe the fundamental arguments for both of those trades, having the two of them has a hedging effect that should help to reduce volatility in your portfolio overall, right, even if you don't get the ratio optimal.
So, right. Erik, are you kind of in Brent's camp that we're going to see a U.S. dollar push to the upside before we see the big decline in the U.S. dollar?
Yeah, I'm very much in Brent's camp that we see a big move to the upside before the opposite. But you know what? I'm also getting older, and I've learned that when you have convictions about how sure you are that one guy's right and the other guy's wrong, we're all fallible. And what I think the real pros in this business look for is, how do I design the trade so that if I'm right, I make a lot of money, and if I'm wrong, I only make a little bit of money. Well, and but I don't lose money either way. And Erik, it is possible in some cases to design those trades, and I think we may be looking at one here.
Erik, one thing that I would do, and without a team of minions, by the way, we're going to have to cut in a clip here of from the Minions cartoon movie of all those minions in there running. But without a team of minions doing the calculations, one of the simple ways that I would put on a risk managed way of doing this is actually just simply by buying deep in the money to this equal ratio. I would buy deep in the money call options on both the GLD and the UUP. So let's say you're going just hypothetically 10% in the money on both of them and getting a delta north of 90 cents on the dollar on your call options. What you have is this beautiful asymmetry from the natural influence of gamma, is that if one is going up and the other is going down, then you're going to get that natural hedging in there. But if the move is extraordinary, let's say the GLD is rocketing higher and the UUP is going lower, as the UUP price is going closer to the strike, its delta is decreasing. So the rate of loss is actually slowing the more wrong you are on the UUP, and yet the delta is firing almost at 1 on the upside of the GLD. So you can actually get a natural delta benefit in using deep in the money options, and it won't cost you a big carry because you're buying huge intrinsic value on the options, smaller capital outlay, and then you don't have to worry about all the complicated risk.
And that also gives you a way, using options without having to use futures, to put leverage on this, because one of my contentions is, no matter what, if one of those guys is proven wrong and the other guy is proven right, then one of those two trades is going down while the other one goes up. And therefore, you need to have some degree of leverage as opposed to just the GLD and UUP shares, which are unlevered. Otherwise, it's going to be a working trade, but a very low performance trade. The options give you that. But I guess the thing, and this is where the math gets a little bit complicated for me, at least to do intuitively, is I completely understand what you're saying, that there's that beautiful skew of where when one of those things starts outperforming, its delta goes up. The thing that's underperforming, its delta goes down. You're making more on the upside than you're losing on the downside. It's a beautiful thing, but there's no free lunch. That comes at the price of purchasing that optionality. Even with an in-the-money option, you're paying something for that. And sure. If the implied vols were 100%, that trade wouldn't make sense because you're paying too much for optionality. So how do you gauge how much that optionality is? Because this, to me, is a trade that you hold over a long period of time. This is not a 1 week or a 2 month or a 3 month outlook. This is a several years kind of trade. If you're going to carry those options, first of all, how much does that optionality cost you over that long period of time? And also, what's the best strategy?
You would have to roll.
No, but you could trade leaps. And actually, if you're going to trade it with that sort of time frame, the theta reaper's a lot less. Right. So I actually think that it's even more suited to the options trade if you're talking about that sort of time frame. There's very liquid markets on the leaps on the GLD, and I don't know about the UUP, but I know that gold, you can trade it long dated options with no problems at all.
Right. Like I'm just looking here. Let's say you're rolling 6 months at a time, right? And so you're going to always roll forward. But right now, a UUP call option to June at the $24 strike. So we're at $25.40 on the UUP. And so you're going $1.40 of intrinsic value by going at the $24 strike. And it last traded at $1.51. So you're only talking about 11 cents of time value on carrying a 6-month option. I mean, there's not a huge data burn on that at all. It's anyway, it's interesting.
So where do we end up with this? What do you guys think in terms of? I've got a view which is I feel like Brent has the right analysis that there's, and I'll have to qualify this too. There's not only is it a matter of getting old and realizing that you're fallible and not always right, but there's also a very, very high probability of the facts changing. And we just had the facts change on us pretty dramatically in the last week or so, when a lot of people were really confident that Jay Powell meant what he said and that the Fed was not going to back away from quantitative tightening just because the stock market throws a temper tantrum. Well, that was a lie. He is going to back away and accommodate the market. We've learned that now. That's a change in thinking. There will probably be more changes in thinking where we have deep-seated assumptions about what the Fed is going to do, what policymakers are going to do. And I'll tell you another one that could really change things quickly is if there's a whole set of expectations on Wall Street about what the Fed will do and won't do in this circumstance or that circumstance, and that's already priced into the market. And then you have, I'll call it a socialist uprising. You have the Democratic Socialists of America really gain traction in polls, and it looks like, well, fortunately, Alexandria Ocasio-Cortez is not old enough to run in the 2020 election. But if someone like her were
Tell
running,
us how you feel, Eric. Don't couch it. Don't be afraid to say what you really think.
let's suppose that someone even more extreme is old enough to run in the 2020 election, and suddenly they're in the lead, and it seems like we're going to not only have the Fed not be allowed to bail out Wall Street, but the Fed will be pressured, and a new Fed chairman will be appointed by a president whose agenda is helicopter money and helicopter money gone wild. Really,
but Eric, can I interrupt for a second?
Totally changes the equation completely.
But how does that change it? I think, aren't we already there with Trump? Like you're worried about the Democrats, but to me, Trump has just gone and done the most leaning on the Fed that we've ever seen any president do, at least publicly, in decades.
Oh, certainly in terms of, and I think he was just not aware that he didn't have the authority to fire him when that started, but because he changed his tune when he figured it out. But yeah. in any case, certainly President Trump has been very outspoken in trying to influence the Fed and to not respect the independence of the Fed. But that's very different from a Bernie Sanders type of president saying, look, we need a Fed chairman who understands that the purpose of the Fed is to print money and hand it out to poor people, and the hell with what the economics say about what that's going to cause in inflation down the road, because by the time that happens, I'll be out of office and I don't care. We don't have that yet, and I'm not saying that that's coming. My point is we are in a fourth turning where people turn to radical political leaders. As Luke Gromen said, if you don't like Donald Trump, just wait till you see the next guy they elect. I don't know what's coming next. And my point is simply, it's not necessarily that specific, prediction about a president having a different Fed policy. The point is, during the time frame of this trade that we're talking about, which I see as several years that you want to be long gold in one way or another, and another part of this equation, by the way, is when would you lift that hedge with the dollar and just say be outright long gold? That needs to play into the strategy at some point too. The point that I'm making is just we are in uncharted political territory, even more so than we're in uncharted financial territory. And anything could happen that could dramatically change the fundamentals over the next several years. And you've got to be ready to adjust your strategy accordingly.
Well, that's some great points. One last question I have for you. As Canadians, we've never had our government take away our gold from us. Unfortunately, you can't say the same in the U.S. Do you worry about that? Do you worry that that someday that the government's going to do the same thing that they did, in the early 1900s and take away the gold?
No, I don't. Well, I worry that they're going to be more efficient about it. I don't think they have any reason to take the gold away. The reason they took the gold away in 1933 was because at the time we were on a quasi-gold standard, and they needed to take the gold away in order to devalue the currency. Today, you can devalue the currency without taking the gold away. What they're going to take away is the profits that you make. And I think that a lot of gold investors are very naive to think, oh boy, I'm the smart guy who sees all this stuff coming that most people in society don't get. So I'm going to be the rich guy in the end. I'm going to get rich on my gold. I don't think that's the way it's likely to go down. I think that what's more likely, as Grant Williams just said on this most recent Macro Voices podcast, is no, what gold is going to do for you is even after you pay the outrageous windfall profits tax that they slap on you for being on the right side of the trade, you'll still have your purchasing power preserved. But the idea that you're going to get filthy rich on gold when gold goes to $10,000, look, when gold goes to $10,000, which I do think is possible, it's going to be because everything else is falling apart at the seams. And that's going to be when governments are taxing the hell out of anybody who's got money. And all of a sudden, anybody who's, got gold is betting against America and they're a traitor and they deserve to be taxed. They'll make something up. You're going to give up a lot of your profits. And the old answer to that was keep physical gold in order to stay out of the financial system. They know what everybody's up to these days. The surveillance state is out of control. So you don't have any option, even if you were willing to skirt the law a little bit. You don't have the option, I don't think, in this day and age to hide your gold.
I actually think, though, that when gold finally makes its move, it's actually going to be because of the dilution of the purchasing value of money, which is actually almost all real assets will be rising at the same time as gold. And it's going to be the fact that the store of value in your money is going to be destroyed as they're basically running a printing press and basically dumping piles of new liquidity into the market. So, I think that gold will have its rise, but I think other asset prices will also be rising in that environment. But we'll see. That's what makes the market.
Well, and I think there's a really good point to be made there, which is in that environment where what's really going on is not the price of gold going up, but the price of dollars going down dramatically.
Right.
And when that happens, which we both predict that it will in the long run, I think it may go the other direction first with the dollar. When that happens, the guys that have gold are going to be perceived, that it's a small minority. It's the people that cheated the system and they didn't feel the pain with the rest of us. And damn it, let's slap a huge windfall profits tax on gold. Politically, that's very easy to do because there's not enough gold holders to have a meaningful vote. On the other hand, if you held real estate, there's so many people that hold real estate that it's very difficult to put a windfall profits tax on real estate. Yeah. So even though I think gold performs much better than real estate in that environment, on a tax adjusted basis, it might not. Yeah. So you really have to think about diversification in that sense.
All right. So to summarize here, in terms of putting on this gold trade, you still think putting on the dollar trade with gold is the right way. And if I could summarize it right, Kev, you think that the best way is to play gold, but crossed against another currency, and the option guy wants to do with options. Is that a good summary?
Sure, sounds great, Patrick.
Anyway.
Yeah, and I guess I'd throw on one more thing, which is you can start with something as simple as Kev's ratio here of 0.148 shares of GLD for every share of UUP. that's a good idea. It's better than just being long one asset with no hedge. And you could get infinitely more complex from there, going all the way up to dynamic computer models that are constantly changing your allocation every day. That's beyond any of us on this call having the resources to really do that. There's lots of levels in between, and the options strategy that you described, Patrick, makes perfect sense for somebody who really understands options. But you don't want to be putting that trade on if you're not an options guy. You haven't taken the big picture trading class. You don't know about it yet. You don't want to put that kind of position on without really understanding what the Greeks mean and you know what is going to happen with those options and when to roll them and all the other things that go into that equation.
Yeah, for sure. All right. So, well, let's move on, Erik, because what I wanted to do, like for those listeners that are not aware, we at Macro Voices, we had a Macro Voices live event out in January in Vancouver. And one of the things that was a part of the show was I spent 3 hours trading live with all of the Macro Voice live attendees that came out and registered for that session. And you came and joined us for about 20 minutes of that live session, sharing some interesting stories about trading your term structure oil trades. But one story that you were sharing that caught my attention, I would love you to share it with all of our Market Huddle listeners, was you were talking about the idea that you were in an oil trade and then you were hedging it out in the futures market with oil put options. And it played out in a fun little way. So why don't you share that story with all of our listeners here and we can talk about it.
Well, Patrick, I don't remember anything playing out in a fun little way. So you must be on a different story than I am. But this is going back to 2011, and at the time, I hadn't really learned how to trade the evolution of time spreads in crude oil yet. And I had a simpler trade at that time, which is I just saw the massive backwardation in crude oil futures, and I thought, you know, if I buy the long-dated crude oil options at a discount and hedge the downside with short-dated options, that is a long trade on crude oil that benefits particularly if that backwardation were to come out of the market, which I predicted it would. And I was actually right. It did come out of the market after that. So I had this trade on that was long a whole bunch of crude oil futures that were 4 or 5 years into the future, and there's very little liquidity in those. And one of the ways that you accumulate them and where you have a benefit of being small in size is you can just keep a constant bid below the market, and occasionally you get hit in the middle of the night with just 1 or 2 contracts when somebody had to liquidate something in those illiquid contracts. And of course you wouldn't want to have that naked exposure, so I was also long put options on the front month. And the idea is that if the futures go down, then the value of the puts goes up and it hedges it. And I had done all the math right. Everything was fine. The market started to crash in 2011. It was like $115, and the next day it was $102 or something. It was a really dramatic sell-off that occurred. And what happened was I was losing money on my crude oil futures at a very prodigious rate. I was making money even faster on the appreciation of my call options. But unbeknownst to me, I'm sorry, my put options, I should have said. Unbeknownst to me, my broker had a rule, which only they have, nobody else in the industry has, which says that not only do you have to have a sufficient account equity in your futures account, but you have to have a positive cash balance. So what's happening is all the cash in my account is getting drained because I'm losing money on the futures, which are cash settled daily. I'm gaining money on the put options because the puts are appreciating dramatically, but that's unrealized capital gains on the put options. It doesn't count towards the cash balance. So even though the total equity in my account overall is increasing, suddenly the margin desk is on the phone, you have to liquidate your positions, and they want to liquidate all of my puts. And I'm like, are you crazy? The market is crashing. You want to wait, it's like buy flood insurance with options. You're buying a protective put. You want to wait until the tidal wave is approaching the beach and we see it coming, and you want to cancel the insurance at that point? Are you crazy? And they're like, look, the long-dated crude oil futures that you have, the bid-ask spread, because the market has gone into panic, is $4 wide.
Right.
It is insane to liquidate your futures because of that ridiculous bid-ask spread. And I have a feeling the broker was on the other side of that spread. So you have to liquidate your puts in order to raise money. I'm like, the puts are what's protecting me. The reason that and I'm like, do you guys look at my account equity is going up? It's higher than it was yesterday or the day before or the day before that.
Now, how did you deal with it? My instinct would be to, if they want to do that, I would maybe roll down my puts to still maintaining a relatively higher delta, but at the same time extracting intrinsic value out of the roll down. So that way you're raising some cash to make sure you don't go negative. Like, how did you end up dealing with
it? Eric, 1 second. It's obvious that Patrick's never been on the wrong side of a market.
Yeah, no. Well,
like I would, I'd so calmly explain to them that this is what you're going to do and that this is how it's going to work. Yeah, Patrick, I don't think that's how it works. I have this little
and this is the thing, is you are at the mercy of, if you have a contract with a broker that says that they can liquidate your positions if their margin policy has been violated. Yeah. They can have wacko margin policy that doesn't make any damn sense and still enforce it. And that's what they were doing. And I said, okay, look, we can solve this problem. What we can do is put on a short on the front month futures contract, because that's going to have the same effect as the puts, which are now in the money. We'll put the short on the front month and we'll liquidate the puts. And they said, no, because your account is in margin deficit and you're not allowed to put new positions on. And I said, wait a minute, that's not what the rule is. You're not allowed to put margin increasing positions on. If you have an outright long and you add a near dated short, that turns your naked long into a calendar spread, which is a lower margin requirement. That is a margin reducing transaction, not a margin increasing transaction. That is allowed. And they said, that's interesting. We don't see it that way, and we're not going to let you do it.
And Eric, correct me if I'm wrong, but when they liquidated half of your position, they actually made the risk of the entire position go up, not down.
Yes, they were dramatically increasing the risk to them and to me by forcing this to happen. Yeah. And you're dealing, somebody made the policy that probably made sense for some other instrument. The guy who's on the margin desk is just enforcing the rule rigidly as it's been presented to him. He's not thinking about what makes sense. And so it's like, are you seriously telling me that as the tidal wave is in sight and approaching the beach, you want me to cancel my flood insurance? Yes, you have to liquidate your puts. And I ended up having to take, I knew that didn't make sense, because as soon as the puts were gone, I was going to, and with no bid, the bid ask spread could get even wider in the futures. So I ended up taking off on both sides because they forced me to do it. And it turned out everything they had told me on the phone about what was supposedly in their customer agreement wasn't in their customer agreement. It didn't really say what they said. I'm like, you guys forced me out of a position that you said was non-compliant with your customer agreement. In the heat of the moment, I don't have the time to go and read, carefully peruse the ins and outs of the agreement. Yeah, I've done it after the fact, and I found out that you frickin' lied. What are we going to do about it? And they're like, we've pretty much locked up every law firm that understands this kind of sophistication, already works for us and is conflicted, and you won't be able to hire them to sue us. Tough shit. And, that is, it's a lesson to me that no matter how smart you think you are, my hedging strategy, frankly, was pretty darn brilliantly engineered. And what was happening is, as the market was going down, I had what I call an overhedge, which is I had out of the money puts, which are super cheap, and I had more puts than I had futures. So as those
that's awesome.
puts started to come into the money, I'm actually seeing a profit, a significant profit, because as those deltas come up, Now it's not just an even hedge, but I'm making money on the downside. It was a brilliantly designed strategy on my part that failed to contemplate this oddity in their policy that they didn't even really have codified in their contract, but they confidently told me on the phone, that's in the contract, we're going to hold you to it, tough shit, you better liquidate your position or we're going to do it for you. I should have, in hindsight, said, you do it for me, I refuse, and let them take action, because in the end now, and this is, they used it against me later, they said, look, you're the one who put that trade on. We didn't force liquidate you out of anything. What are you going to sue us over? We didn't do anything. You did it. Well,
So-
I did it under duress while you guys were on the phone telling me that I had to liquidate my flood insurance as the tidal wave was approaching, or else you were going to do it for me. And I could see that you were doing stupid things. I tried to do something that made a little bit more sense. What we should have done is exactly nothing, because the whole thing would have been profitable, but you're imposing a rule that's not really even in your contract, and I fell for it. And they said, well, good luck finding a lawyer to represent you on that one.
So the $64 million question, Eric, is, are you going to tell us the name of the broker?
Oh,
You don't have to, but
I know it. He said it before, but
don't say it on air. Well, that's one for over beers, and you'll have to catch Eric sometime at a bar to get to the name of that firm.
yeah,
we might need them as a sponsor someday. You never know.
That's right.
All right. Well, Eric, thanks so much for sharing that tale from the trading desk. That was truly some wisdom for our listeners. Nonetheless, any parting words?
No, I think it's really great that you guys are putting this YouTube channel together. One of the things I've always said is it's so disappointing to me to see some people in financial podcasting. They're like, oh, these guys are competition with me. I'm going to compete with it. It's such nonsense. Let's all work together to help each other find the best guests to create more fantastic financial podcast content on the internet. And my hat's off to you guys for putting, it's a different format than Macro Voices. I'm glad to see you doing it, and I encourage our listeners to follow your work. It looks like super stuff.
Well, thanks for those kind words, Eric. That's really kind.
All right. Well, thanks, Eric, and have a great rest of a weekend.
Okay. We'll see you next time, guys.
All right. Thanks.
Sure.
So, Kev, it was great to have Eric on the show. I thought that was a pretty interesting conversation. But the one thing I wanted to carry on with is, well, guess what? The historic flip-flop of Jay Powell.
Yeah. It's unbelievable.
But you know what? It's not that our listeners didn't know, because you were all over this last week.
Well, I've gotten it wrong too. I didn't think he would go this kind of flip-flop-ish. I thought to myself, there's no way he could go into this Fed meeting and be any more dovish than the already dovish expectations, and somehow he managed to do it. It's just shocking. I saw all sorts of, seasoned professionals that were saying in their 30-year careers, this is the biggest flip-flop they have ever seen from a Fed chairman. Yeah. And just, the important thing that I want everyone to know and understand is I'm not disagreeing with whether flip-flop or whether, being dovish at this stage of the cycle is correct or not. What I'm kind of, I guess not frustrated isn't the right word, but at least disappointed in Powell is how he communicated this. Don't forget, it was October 3rd. He was saying how we were a long way from neutral. And a long way, not meaning that they tightened too much, meaning that they still had a long way to tighten. Yeah. And you might say, well, since then, a lot's changed. But a lot had changed going into the December meeting. And the December meeting was just, a month and a half ago. And at that meeting, don't forget, they tightened the reserve rate. They said that the Fed's balance sheet was on autopilot. And he gave no signs of being anything like, the message was clear. We aren't going to worry about the stock market. And if you're going to make that decision, stick with it. And I'm kind of disappointed in terms of the miscommunication that he's done. And I think ultimately it's going to cost the Fed a lot, because what's going to happen the next time the stock market starts to go down and we all think that he tries to tell, no, it's not going to matter. I'm not going to tighten. I'm sorry, I'm not going to bend to your will. He's shown himself to be just as bad as Yellen and Bernanke. He came trying to argue. Yep.
So let me ask you this, all right? Correct me if I'm being naive about this, but I believe that there's that the Fed is really the market's bitch. Like the way I look at it is that the market really
yeah.
gives the Fed the permission to act. Like for instance, in December, the market continued to fully price in the December hike, and the Fed, how can you, knowing that they didn't want to raise or not raise, if the market was saying we're pricing in that rate hike, why would he not do the hike? But yet now what you can see is that the market is basically in the euro dollar futures curves and everything saying that they're done. And so they basically are taking the cue from the market. They're basically saying the market is saying we shouldn't do it. So
No, but he was fighting it a lot more than a lot of other Fed chairmen. And I completely disagree with you. And I think that he was trying to signal, and he was trying to get basically the market to stop that kind of feeling that they could dictate Fed policy. He was trying to set Fed policy by the economy, not by the market. And he was desperately trying to wean us off of that. And he was holding tough, and he was being, steadfast in his resolution in terms of that. And then when it really came down to it, like I wrote a piece and I said, there's no atheists in foxholes. Ultimately, he fell short. And I just think if you're going to be a flip-flopper, he should have flip-flopped a lot earlier. Like, really? Think back, that all that pain that we experienced in late December was because he showed no signs of wanting to give into the market.
But listen, I'm a guy that looks at the really big picture, and I kind of look at that. Look, there's these kind of 7 to 10 year business cycles, credit cycles. You can look at all sorts of different monetary cycles that come in there. We're at the tail end of one of these cycles. Obviously, whether we're 6 months forward or 6 months backward, where we are in the cycle is to be debated by economists till we're blue in our face. But to me, we're still at the stage where they raised interest rates to essentially slow the economy. Maybe the economy is slowing globally much more than it is domestically in the United States. But there is a slowdown. And inevitably, just like what we're now seeing in Italy being announced, we're seeing that the recessions around the world are starting to rear their heads. And I think that this still just plays out the same as always. The Fed is going to just pause. The economy is going to continue to tighten. And the economic metrics are going to continue to slow, and then we're going to fall into a slowdown. Maybe we'll call it a recession. There's going to be something, but this is just a cycle playing out, no?
But yeah, you know what? I'm in the same camp. I think the economy is weaker than the market might indicate, and I think that the global economy is rolling over. There's real problems in China. There's real problems in Europe. So I'm sympathetic to your argument. But don't forget, what if we're wrong? And, as traders, we always have to think that that's a possibility, and you always have to keep that in the back of your mind. And what if the U.S. economy is stronger than we all expected? What if Powell was correct in his previous policies where he, said we're a long way from neutral? What if, we had an unemployment number today, and the unemployment number was quite strong. And what happens now if after this historic flip-flop where he's basically affirmed the market's hissy fit that it threw, he ends up having to go back and go start raising rates again? Do you think people are going to believe him? I really think that he's done himself a huge disservice. I think that he was...
You think that he should always be late to the game then?
No, I don't think he should be late to the game. I think he should be consistent. And I disagree with you that he is applying consistent methodology to his policies. I think that for a while he was worried about the financial conditions more so than he was worried about inflation. And now, after the financial conditions started to tighten and the stock market started to go down, he changed his tune.
Right.
And I think that was much different. If Neil Kashkari had been the Fed chairman and been done this, I wouldn't have been surprised. But this is Powell, and he was trying to convince us. He was trying to get the market off of this idea. He was trying to be different than Powell and then Yellen and Bernanke. And that was his whole, that was his shtick. You know what I mean? That was what he was about. And he was making progress, and right or wrong, and I'm not here to just tell you whether it was right or wrong, but that was what he was trying to convince the market. And now,
But he's
he's completely gone the other way.
you said it. What he's tried to convince the market, but I still think he's hostage to the market. He's the market's bitch, and I think the market spoke, and he had to act.
I guess so, but he tried to tell everyone that he wasn't gonna do that, and he was gonna hang tough. I have a very seasoned pal that has seen a lot of cycles, and he contends that this flip flop by Jay Powell is the biggest embracing of kind of easy policies that he has seen since Abenomics and when Kuroda went full kind of
Really.
Yeah. That's how much he thought it was a shift in policy.
Really?
I don't.
That's like, okay, maybe I'm naive because I didn't know. I didn't like. I mean, I recognize it was a huge dovish flop, like that I will accept, but that big, eh?
Yeah, no, and I made sure I sent him a Bloomberg message to saying, "Are you sure are you like this is what you think?" And he says, "Yeah, it's that big a deal." So I really think, and you know what? Regardless if he's right or not, that's how the market is interpreting it.
Yeah.
And so he might be miscommunicating once again. And that is what I am scared about.
Right.
Now, I don't know whether the economy is going to roll over and this is the right thing to do, at which point, it's all moot. You're right. What's going to happen is the economy is going to roll over and then he's going to chase it on the way down. But I am worried that if we're wrong about the resiliency of the U.S. Kind of economy, that he has done himself a huge disservice. And not only that, this miscommunication, he has stumbled badly in terms of, communicating with the market.
Hey, Kev, let's carry on. I think we have a conversation to be had here in the WTF video later on.
So let's go to This Week in Trading History, and let's go back to 1997 when the Federal Reserve not the Federal Reserve, the Treasury auctioned off its first inflation index security.
The TIPS.
Otherwise known as TIPS.
Right.
And I think this is a really great topic for today, given the fact that if Powell is gone completely dovish, inflation might be coming back in a big way, and investors are kind of stuck wondering, how do you protect yourself against them?
Oh, come on. You think that just because he flip-flopped that suddenly that's implying that inflation's about to rip? It's not like MMT is here.
Well, we're going to save that for another week.
Yes.
But I think that
come on. I'm not in that camp. Anyway, go on with your.
Let's just oils continue going up. And anyways, let's go back to this, because regardless, investors should be aware of TIPS and they should understand them, and they should be kind of knowledgeable about the different parts of it. So let's go through, and I've actually made a few charts here to show us. And what I've done is I've chosen the 30-year TIPS yield versus the 30-year straight Treasury yield.
Right.
So the bottom line is the 30-year TIPS yield. And what that means is that that's the yield on the TIPS bond, but you get 1.10% plus inflation. Okay, right. So think about that.
But you have to trust the inflation numbers are real.
What? Yeah. Okay. So true tinfoil hat guy.
We need to bring Williams on to the.
That's right, the shadow guy.
Yeah.
So anyway, so there it is. 1 point. So if you go buy a 30-year TIPS, what you get is a yield of 1.10 or 1.098 plus the inflation over that period. Right. And if you look at the difference between that yield and the yield on the straight regular 30-year Treasury bond, what that is the break even. Right. Meaning that if that inflation ends up being higher than that level, at that point, you would have been better off owning TIPS. And if it ends up being lower than that level, then you would have been better off owning straight regular treasuries.
Right.
So let's go to the next chart. You can see that what I've done is I've actually plotted this break even level. And I just want people to understand that's all the break even level is the difference between the yield on the regular bond and the TIP bond. And you'll see that kind of, this is a long chart. This is from 2008. Yeah. You'll see that in the great financial crisis, it went down. It almost hit zero. The market was very pessimistic that we'd ever see inflation. It very quickly punched back up once Bernanke started printing.
Right.
And then it's slowly gone back down. 2015, it kind of bottomed out at 1.5%. And then, it started rising again. It went up to 2.25%. But if you look at the chart in the last, last couple of months, you'll see that it had gone from 2.25 all the way down to 175.
Yeah.
And that reflected basically what Powell just panicked about. It was a deflationary wave that was hitting all the markets. It was oil going from whatever it was, $70 down to 45.
So correct me if I'm wrong, but if we went Europe, like, is there a TIPS contract in Europe?
For sure. They're all over the world.
So is the break even on the European contract negative?
No, it won't be negative, but I think it's pretty close to zero. I do believe that the tip on the Japanese one is almost zero. It's even worse than the European one.
Because the way I look at it is that even if your interest rates aren't at zero on a nominal level, on a real basis, they could actually be negative real yields. But when we're expressing it as a break even, you're saying that they don't go negative that way on these?
Well, so this gets a little more complicated because U.S. Treasury tips can't take away. They don't it's stopped at zero on inflation, and
right.
it's even more complicated than that because it kind of accrues, so it's not perfect. So it's a little more sophisticated than that. But you're kind of jumping way out ahead. Let's go to the next. Let's go to the next idea. So a lot of investors look at this and they say, how do I buy that break-even level? Like, how do I go about executing a trade that will benefit if we get a situation where perceived inflation over the next 30 years rises? So, we heard Erik pine on about if AOC gets elected, that we could see as a situation where inflation takes off. And what would be a trade that you might be able to put on that would protect you against that? Well, owning break-evens would be one of those trades, I think. But the trouble is, how do you do that? Well, you can't just go buy the Treasury tip on its own because there's a fixed income element to it, meaning that it's still a bond. So it's still going to go up and down with interest rates. And if interest rates go from so let's say that the long end is 3%. If they go from 3% to 6% because we're getting raging inflation, then you're still going to have that bond element that's going to lose. So the way to do it is actually to be short the bonds against it. And that is, in essence, the difference between the one yield versus the other yield is that break-even level. So here I put a screen up, and what it is it takes the on-the-run TIPS 30-year bond, which is the 1% of February 2048, right. And it shows that if you buy it, I guess that's $10 million that you buy. I always like to, when I'm making my position screens, I always imagine that I'm Stanley Druckenmiller and I'm just tossing around 10 million bucks like nobody's business. So you buy 10 million bucks of that, and then you go, and I've chosen the ultra long bond. And some people might say to me, why did you choose the ultra long bond instead of the 30-year bond? Because isn't this a 30-year issue?
So the ultra long is constant 30 years, right?
Well, so it gets complicated because you have to go look at the cheapest to deliver. The ultra long is longer than the 30-year bond future. Okay. And it is actually closer in terms of duration to actually the kind of equivalent tip that right. 2048. Okay. So that's we just want as long a future as we can get. Mm-hmm. So then we go look at it and you buy 10 million bucks of that, and then you short 91 futures of the ultra long bond, and there you go. And you'll see on the far right thing, you'll see that that's basis point value change. So if tips move up 1 basis point, you'll lose 25,000. If they move down, you'll lose 25,000. And then the same on the bottom for the ultra long bond.
Right.
And so what that spread enables you to do is actually go long the break-even level. Right. So that is in essence creating a trade that is long the break-even. And if you go do that in an account, you can put up very little margin on the tips. Like I don't know what the number is. It might be 5%. It might be 3%, 2%. I'm not sure. And then the future is the same way. And it's a very efficient way to kind of bet on inflation in the future. Like I think it's an underutilized thing. And if you go to your IB and pull up that on the run tips bond, you'd be surprised at how liquid it is.
Right.
Now, so that's kind of the institutional way to play it. Here's another way with a lot more costs. That's the next screen. And what it is the RINF ETF. And what this is an ETF, and it's very thin, and so be careful with it. But it's an ETF that basically invests in swaps on the break-even level. Now the fees are higher, and it's kind of illiquid
because it's retail.
Yeah, it's retail, exactly. But this is something that you should just kind of have a look at in terms of you want something that is executing or reflecting the break-even levels.
Right.
And I think it's an interesting little product, and I wish it traded more.
It would have been a great way to put it on, but I'm gonna certainly look at this to see whether or not I want to put. But what, I'm a deflationist at heart. But
you should be going the other. Hey, listen, 1 second, Patrick. You can go backwards.
I could definitely go backwards. I was about to say
short those tips, because you know what, 2.2% inflation break evens. Those are insane in your mind. Like they're going to zero.
Well, for sure. Well, you know what though? I'll tell you. You scared me with your little MMT thing, because that is a game changer. But until it's here, I do think that deflation will come before inflation. But that is a game changer. Like when we have some sort of political shift of that kind of magnitude where we redefine money, then that could become incredibly inflationary, and that would be an amazing time to flip flop with this kind of a trade, wouldn't it?
For sure. If we get a MMT instituted, and that's a big if. And
that's a big if.
And we're going to talk about this in future shows, because I think it deserves its own
By the way,
show.
for our listeners that don't know what MMT is, it's the modern monetary theory, which is a new way of looking at money in terms of where the only constraint to money printing is inflation. We're not going to get into the details, but just when you hear us always referencing MMT, we're talking about this new way. Well, it's not, it was interesting. I saw a message and they said it's not all that new. They did it in the USSR. But anyway, it would be
all you hard money guys putting in your digs at MMT. I actually appeared on with Erik and Patrick on Macro Voices, and I could just tell Erik was seething when he was thinking about it. Like, it's just to him, this was just the most crazy thing in the world. And I wrote a piece about it, and I the one thing that was interesting that I do want to talk about a little.
You know what, Kev? Make sure that when you send out the Market Huddle weekly email, that you included your blog link to it. Because
for sure, I will for sure do that.
I think our listeners need to read it, because it's like you said at the beginning of it. If you're ever going to read only one macro tourism blog this year, read this one. Right. And I think you nailed it.
Right. And what I'm shocked about is the amount of closet MMT guys there are out there. And meaning that after I wrote my piece, a lot of guys were reaching out and saying, you know what, I actually believe in these things. And this is how I do. And listen, I want to say another thing. Even if you don't believe, regardless of whether you think it's the right path for our society to take, the MMT guys knew that QE wouldn't cause inflation. So all you hard money guys that were freaking out about all the money printing and writing, kind of taking out full page articles in the Wall Street Journal,
those guys were
all those guys, MMT said, no, that's not going to actually cause inflation. So regardless,
and I was in that camp. I'm a deflationist, right? Like in the existing monetary system, in my view, is that it's very hard to create inflation, but MMT can create inflation.
But like thought that, you probably didn't think that in 2011 when Bernanke was doing it. And the MMT guys understood that wasn't going to be the case, and that wouldn't create the inflation. And so regardless of whether you believe the policies are right or wrong, it's an interesting way of thinking about economics and thinking about the markets. Because in
it's a Pandora's box, dude. If we ever go down that road, there's no going back.
So let's save this for another show, because we're very quickly going.
All right, okay. We're ending it here. Stop.
Okay.
Right now. All right. Let's move on. All right. Everyone's waiting for it. Let's do it. The WTF video clip of the week, Kev. So what do we have in store for everyone?
When I saw Jay Powell do his flip-flop, all I could think was more cowbell.
Let's just run it. Let's just run this.
Run it.
All right, guys, I think we're ready.
We think about a broad range of financial conditions, not just one or two things. It's interest rates, it's risk spreads, it's currency, it's the stock market, it's credit availability, it's many, many factors.
By the way, my name is Bruce Dickinson. Yes, the Bruce Dickinson. And I gotta tell you, fellas, you have got what appears to be a dynamite sound.
And what matters for financial conditions is when there are changes, and those changes are sustained for a period of time, then they become important for us because they have important macroeconomic implications.
All right, here we go. Don't fear the reaper. Take one, roll it. All right, 1, 2.
So that's how we think about it. So we don't react to, to most things that happen in the financial markets, but when we see a sustained change in financial conditions, then that's something that has to play into our thinking.
So, let's take it again. And Gene.
Yeah.
Really explore the studio space this time.
You got it, Bruce.
I mean, really.
Yeah.
Explore the space. Okay. I like what I'm hearing. Roll it.
In fact, our policy works through changing financial conditions, so it's sort of the essence of what we do.
Thanks, Jim Kuzengaro with the LA Times. You and your colleagues may have noticed President Trump for the past 6 months has been urging the Fed not to raise rates, to stop raising rates.
Fellas, no, we just wasted 2 good tracks. This last one was even better than the first.
Well, it's just that I find Gene's cowbell playing distracting.
How would you respond to those who would suggest that the Fed just caved to the president's demands?
You know, I can pull it back a little if you like.
Not too much, though. I'm telling you, fellas, you're gonna want that cowbell.
So what we care about, and really the only thing we care about at the Fed,
That it doesn't work for me. I gotta have more cowbell.
is doing our job for the American people and using our tools appropriately.
Can I just say one thing?
Say it, baby, just say it.
I'm standing here staring at rock legend Bruce Dickinson.
The cock and a walk, baby.
And if Bruce Dickinson wants more cowbell, we should probably give him more cowbell.
Say it, baby.
So that's very strongly our culture. I think anyone who knows the Fed or who has worked at the Fed would recognize that description. So we're always going to do what we think is the right thing. We're never going to take political considerations into account or discuss them as part of our work.
Oh, Kev, you know what? All we needed was more cowbell.
That's right. Trump demanded more cowbell, and Jay kind of came up big time.
He came in. He came in.
Yeah. You know what's interesting is actually Charlie McElliott wrote a great piece of the Nomura strategist that we all love so much. He wrote a great piece, and he said that Jay Powell was forced to bend the knee.
Come to King's Landing, bend the knee, or suffer the fate of all traitors.
This war has already wiped one great house from the world. Don't let it happen again. Bend the knee.
And I just thought that was the funniest, that's a Game of Thrones reference. And I thought that was the funniest thing he really did. Like, he unfortunately just completely caved to both the market and to Trump and to everyone and gave them what they wanted.
Yeah.
And it should be interesting to see the ramifications of this, abrupt change of policy.
No, I couldn't agree more. I think we already beat the dead horse here. We've already talked about it, so let's move on. Kevin, it's time for another beer. It's time for top 5 things to watch next week. And let's start off, though, with what we reviewed last week, or what our top 5 things were last week. And so let's hit them. Number 5 was the VXX and the VXZ notes maturing. Anything to say there, I guess?
Well, it ended up being kind of a non-event, but it was, I guess, unless you forgot about it and you let your position expire. But in terms of actual affecting the VIX index, it was a non-event.
Yeah. Well, at number 4, you were Hulk smashing Brazil, and it kept going.
Yeah, it just keeps going. Now, listen, Powell made it easy though, right?
Yeah, he did make it easy. But what's interesting, now you were looking at the Brazilian index as it's priced in real. By the way, I had someone correct me on the pronunciations, Vale and real. But what I was just going to point out is that in U.S. dollar terms, when you look at, let's say, something like the Brazilian index, there's a squiggle level coming up along those highs back in the start of 2018. Those highs on the ETF for Brazil were around that 47, 48. Wouldn't it be convenient if that is where the rally was contained to?
Well, here I have a question for you in terms of the squiggle levels. That usually the squiggle level, like where you would expect selling, is because other people are going to sell at that level. Is that correct? Like, let me
there's a self-fulfilling prophecy to squiggles for sure. But then the question is, should it be done in the main index or the U.S. dollar index?
Exactly.
Oh yeah, I agree. But there is using something like a technical measured move, whether you did it on the one index or the not, or the other, there is a measured move that is actually finishing up there. Now, one is to an overhead resistance. The other one is still on a proportional move. Point is that my view is this: there's more upside. It might even tack on another $1 or $2 on this ETF on a relative basis on the cash and on its relative index. But I think that it's, let's say, in the 7th to 8th inning of this leg of the move. It doesn't mean that it's going to turn into a bear market on the other side. But I think that if you're buying Brazil right now, chasing this, that you're kind of getting in late in late innings of this game particularly.
Well, you know that it's late innings because I actually noticed a technical pattern of a breakout. So
when it made our top 5 things, and it's
for me, when Kevin starts talking squiggles and breakouts, you know it's over.
And Hulk smashes, that is.
Yeah, that's right. So it's over.
Well, let's move on to number 3 and the dollar index and the reversal on the ECB. What was clear is that the Wall Street Journal article completely reversed, and the Fed completely smashed it, right? And so we had essentially the dollar index really come off of those that Fibonacci level, which me and you talked about. And in my mind, there's a good chance that the dollar here is just going to continue to take a break. I mean, a dovish Fed like this takes a lot of the short-term fuel out of the dollar, doesn't it?
Well, I'll tell you one thing. I'm shocked that the dollar it can't go down. Yeah.
Really? Well, you know what? I actually still think the dollar index has a magnet down to this previous low around 94. And I mean, that's not a big move, though. I mean, that's just $1. That's $1 and change.
Maybe you're right. I don't know, but I would have expected the dollar to be down more.
Yeah. Well, listen,
to me, it's actually kind of a little bit worrisome to risk assets that it's not going down more.
I think that it's more about a gold trade, which is that if the dollar makes that break to 94, that will really not impede gold from finishing a move to towards 1350 to 1400 an ounce. So I think it's more about being long gold and seeing whether or not the dollar gives it that tailwind to make that move, right? That's my view.
Yeah, it'll be interesting. You know, one thing that I'd like to just highlight is the renminbi, the Chinese currency. Even with all this terrible news and the whole kind of last week, all we got was terrible PMIs, terrible kind of economic indicators. The renminbi keeps strengthening. You know, we were kind of 695, and we've all gone down.
You're really going off of the chart, but here, let's put it up here. But this is the yuan against.
Oh, there you go. You're always putting it backwards on me, but yeah.
Well, okay. Well, you want me to flip it? I'll flip it.
Yeah.
Okay. You want to look at the.
There we go. So you'll see that decline was yuan strength and
U.S. dollar weakness, yuan strength,
and it just kind of shows you why you can't trade this currency based upon fundamentals. All the news was bad on China, all over and over and over.
Oh, come on, but Kev, you know better than I do. You know better than I do that the market is 6 months ahead of data. And so that entire monstrous move in the dollar against the Chinese yuan that occurred last year from the summer to December was very much a manifestation of the fact that everyone knew this was going to be shit.
Well, I actually think it's more political.
You think so?
Yeah, I think that this thing is a complete political football that they peg it where they need to peg it for at the time.
So please tell me what is the right way of trading this, because I know you're setting this up. What is
so if you're bearish on China
on this or anything, right?
Yeah, if you're bearish on China, you should short odd CAD, Australia dollar CAD. I think that is the best way to do this trade. And what's interesting is that even in this kind of rip roaring market higher, this pair has not rallied.
Yeah.
So I kind of view that as vindication.
Vindication. The victory lap is already being run by.
No, vindication that this is the way to play this trade, because if you are kind of taking the Kyle Bass route, that China's
taking the yuan directly,
then you're getting crushed. Meanwhile, if you do this trade, this is a much better, cleaner way to do it. So I love this trade. I think it's a great trade. Shorting odd CAD. I think that. Who's Australia's biggest trading partner? It's China. Who's Canada's biggest trading partner? It's the U.S. And then you eliminate all the problems that are associated with the either the political nature of CNH or CNY, and then also you get the whole issue about the risk on, risk off kind of reserve currency gets taken away. To me, it's a kind of a great trade.
All right. So number 2, earnings. Caterpillar missed. That's the big global economy play. Apple reacted positively, but I think it was very much a function of the fact that it got murdered to the downside. All expectations were wiped out. So it was really the hurdle has been lowered to the point that it's like easy for Apple to beat it. And so there was a positive reaction. Microsoft weak. Amazon broke badly, and Exxon was pretty positive, at least on the first reaction to the earnings. Did you have anything else beyond what I summarized there to add there?
Not really on those specific names. Well, I guess Caterpillar, I really think that it's the kind of poster child for the global economy, and the fact that it was bad is
a testament to the situation, right?
Right.
And I don't think we're going to talk about number 1, though, because I think we've already beaten this one to
for
death.
Sure.
FOMC. So
we made it the number 1 things to watch, and I kind of did it half-heartedly, thinking there was no way that it was going to kind of live up to expectations,
and it blew past it.
It was just unbelievable.
It was unbelievable. So let's move on. Let's bring all of our listeners to what we believe next week is the most important things to watch. So let's start off with number 5, and that is platinum. I'm just digging up the chart right over here on my side screen. But what's interesting is, palladium, we talked about it when we were doing our show, right? And we were talking about that it like ran away like it stole something, right?
Yeah, it's just unbelievable.
And at the same time, and gold and silver were like running and breaking out legitimately. But then there was the last precious metal. And this one has not yet broken out.
It's terrible. It's just sucking wind.
It's sucking wind. But will it stop sucking wind?
I don't know. It looks like me after a squash match. Like it just
a squash match.
Yeah. Like it's just awful.
But
I saw some lunatic on Twitter that was someone asked one of those trades, like, what is your best trade of 2019? And everyone's putting their best ideas out forward. And he put on buy platinum, short palladium. And I thought, my God, that guy is either going to be so right or so wrong. And I thought that's a ballsy trade. And I was like, hats off to you.
Well, palladium sort of kind of peaked after the moment you pointed it out. Let's be realistic.
Of course.
You marked the top by bringing it to everyone's attention. The algos faded the Kevin Muir.
That's right. I don't think I said buy it, though. Let's be fair. I'm not quite that bad. I'm not Dennis Gartman or anything like that. Like,
not yet. You're working on it. I mean, if you could only have that much pull.
That's right. It's hard to be that wrong.
Consistently.
Yeah, that's right. Anyways, going back to platinum, I don't like it's interesting. It's definitely.
I don't have an opinion either. I don't think either of us do. But you know what, though? It's just going to be worthwhile watching whether or not it can break out those highs where it put it in January. And maybe that will start something. It started it for gold and silver. Maybe platinum is just running a little bit behind, and maybe it'll get some tailwind here. But
maybe we need platinum to join the party for it to be a true precious metals bull market.
No guff. It's totally necessary. Yeah. So let's go number 4, lumber. And I added the home builders part to this after you started ranting when I told you I wanted to talk lumber.
I did not rant.
You were ranting, my friend. And so, but
you know what? Okay, so for people that are new to the show, we had kind of a joke because at one point Patrick asked me what I thought was one of the best sectors to own for 2019, and I said I really think that home builders are going to surprise everyone to the upside. And when I told that, like the howls of laughter from Patrick was
you're crazy. You're crazy.
No. Yeah, and then his members jumped on the bandwagon, and next thing I know, I was just getting inundated with people like shitting all over my home builders call. And I really do believe that long term, the American millennials have not bought houses. They have not gone out. Canadian millennials are.
You're getting like full Josh Steiner hedge eye shit here.
I
need to get into
swallow
like,
that
your little group hug circle and like rejoice about this big millennial wave that's coming.
Hey, by the way, can I just say one thing? So at the time, Keith McCullough, the kind of founder of Hedge Eye. He's often
the founder. He is the founder.
Okay, the founder of Hedge Eye. He's often he sometimes can be abrasive and
for a Canadian, he's
no. He is. He's from Thunder Bay. And I must say, I've been listening to him lately, and I don't know if he's been taking his nice pills or something has happened to him. He's actually been outstanding, and I actually I think his process is terrific. I've been watching a few macro shows, and I've been just I love it. And I'm so happy that he's kind of returning to his Canadian roots and being a little less hostile and getting in fights with everyone. It's been much more enjoyable to watch, and I'm really happy with it. I think it's terrific. Anyways,
all right, listen,
just a little aside.
Keith, if you're listening, with Keith McCullough, then
Keith, if you're listening, buddy, keep it up because I love it. But anyways, going back to the home builders.
No, forget the home builders. We're talking lumber, dude.
I know lumber just kind of Powell just ignited it.
All right. So look, we'll get to home builders here in a second, right? But let's be realistic. There was a bloodbath, a monstrous rally, and a murderous bear market rip from 660 highs down to 300, more than a 50% wipeout.
It's just it's a crazy commodity to trade. Let's face it.
Oh, and it's not very liquid either, right?
Yeah. And the other thing is it's got a stupid limit. So it goes limit up or down every single time. It only trades 10% of the time because it's always locked limit. No, seriously. You think I'm kidding about this?
We were talking that nothing goes lock limit anymore, but now you can go to the.
But lumber still does because it's got a $15 limit and it locks all the time.
Right.
It seriously locks limit. You'll see it. Lumber lock limit up. Lumber lock limit down.
Yeah.
I don't know. It's old school anyway. They don't want to trade.
What a rip. I know, listen, you're saying Powell and everything, but Powell's only been out for a couple trading sessions. This lumber move started 2 weeks ago.
Yeah, but it started, go back to when Williams came out to the Fed and actually said that they were going to, when
that was Jan 11th at the first little breakout candle.
Yeah, but realistically, look at it, the Fed.
The real breakout was on the 24th of Jan.
I don't know if it was specific to the Fed, but you have it in easy Fed. You have the dollar kind of marginally going down. You have a lot of things lining up for lumber to go up.
All right. So let's move on to the home builders now, which obviously have a correlation.
Don't do HXB, do ITB.
Yeah,
HXB has got all sorts of whirlpool and stuff.
So here we have the ITB.
That's right. Just for those people at home that aren't aware, XHB has got Whirlpool and kind of Home Depot or crazy stuff
Lowe's,
like that.
Home Depot, all of them.
And ITB is purely home builders. So if you want to bet on home builders, choose ITB. Anyways,
it sounds like a commercial. You're like, that's so funny. Right.
Well, you know what? We have a running bet that ITB is going to outpace the TLT, and we have another steak dinner on it. So I'm hoping that I'm right. Because
you know what, ITB, if we're only judging it by February or March, you're going to be right. But
no, it's a long. We got a whole year.
By the end of the year, I'm going to destroy you, dude.
Okay, that could be. I'm not going to count my chickens. We are so far away from being like. I just hope I get a nice big lead so that it doesn't like. There's no way you're going to win. Anyway,
but it's a breakout in lumber, and it's a breakout in the home builders. It's working, and because I am not yet super bearish for the next leg of the bear market, I think there's more room for these things to go. There's more room in the coming month for them to gain. I think that you want to buy dips, but you can lean into these a little bit for the next couple of weeks for sure.
Especially with Powell being dovish.
Oh,
like
look, the market's overdue for a throwback, so you don't want to go and just buy an uptick. But if the market offers us a dip, I think it would behoove us not to take it.
Okay, let's move on to number 3.
Kev, number 3.
Powell speaking on Wednesday. Unbelievable that he's going to get another chance to fix all of his mistakes.
No, he's not. Listen, this is a town hall meeting for teachers. You know what? With what he just did, how can everyone not be hanging on every next word he's going to say? And so it's not that we're expecting him to say anything big, but at this stage, he sort of has now made himself the centerpiece of everything, hasn't he?
Well, I agree that he has. Here's my prediction. The Fed is going to try to go quiet as much as they can. They are going to try to get out of the way and make themselves not the center of attention. So I wouldn't be surprised if he ducked every single question like that, and that the Fed board members, the FOMC board members, are surprisingly quiet. I think the worst, like if they go the other way and try to talk the market the other way, we're going to be like, everyone's going to be like, their heads are going to go on it. They're going to be on a swivel from back and forth, and they're going to be getting sick from the rocking of the boat.
Well, they just gave Trump what he wanted, so why wouldn't they stay silent and just
Yeah. I agree. So that's most likely what's going to be happening.
They took the knee. Now they're just going to move.
That's right. Bend the knee, Powell.
All right. So number 2, we were going to talk about yields. And so really what was interesting was the first reaction to the Fed was the bonds rose and interest rates went down. And that almost, to one degree or another, makes sense because, I mean, if you have that much of a dovish flip-flop, something must be wrong.
Well, I don't know if something's wrong. I'm interested that the curve steepened like unbelievable.
Okay, we'll talk about the curve in a moment. But I was talking about is this. Look, and it reversed today, but the first reaction to Powell was this big spike higher in the 10-year futures, which is basically the yields dropping. Now, obviously, today's jobs numbers gave us the complete flip-flop on this. And this is what I thought was particularly interesting. For me, I suspected, at least for us being a squiggles guy, looking at the technicals, I thought bonds would remain in consolidation for much of the first quarter. And so if we were to get a huge bull breakout here in bonds, that would have actually caught me off guard. And so the question is, with the strong jobs number here, do bonds continue in consolidation, which is the 10-year yields continue to kind of work their way a little bit higher? Maybe we go 280, 285, 290 on the yields. Is that unreasonable? What's your thinking?
Well, so what you're arguing that we're just kind of going to go nowhere. If anything, the bond sells off a little bit and yields go higher. Is that what your argument is?
Well, I was kind of shocked that it looked like the bonds were about to rip. Like I just look, I'm bullish bonds. I'm bullish treasury.
Oh, you were surprised that they did as well as they did on the Fed announcement?
Yeah, I was just surprised it was happening so fast. Like I didn't think this was the right time for the bonds to make their next move. But anyway, you could see it's pausing here. Yeah. But now you wanted to talk the spreads. Now you want the 530s?
Yeah, that's my favorite play. I love this trade.
Well, you just got Prairie Dog, didn't you?
Prairie dog. It's a noble animal. Don't sell them short. I guess you're right. The thing about it is that these kind of yield curve trades, they don't trade well technically. Maybe that's why I like them so much. They're very choppy. There's the breakouts.
You like to chop.
I like the chop. I guess it's just the nature of how I didn't grow up in a kind of a trending environment. I'm an index derivative trader by nature. I was actually doing index ARB. So usually I would be on the other side of kind of when everyone was reaching for stock futures, I was selling it to them and buying the cash. So inevitably I was usually fading stuff. And that's just kind of my nature. I don't love, I'm not a trend follower, although I do think that the trend followers, I have a lot of respect for them because it's a great strategy.
Tony Greer, we had that guy on the show. We should have him back sometime, eh?
Yeah, we should have him back because you know what? The funny, just as a little aside here, while Patrick was editing the show, I got this text, and I look at my text this Saturday morning, and I know Patrick's busy at work editing the show, and he says, I just think I heard 5 beers that Tony opened during the taping of our show.
Yeah.
And Tony was on for half the show. I was like, come on, you got to be kidding me. So Tony's one of my buddies. So I emailed him or texted him and said, did you drink 5 beers while you were taping our show? And he's damn right I did drink 5 beers. So he's definitely our kind of guy. He's a market muddle kind of guy. There's no doubt about it.
Yeah, the market muddle, not the huddle.
Yeah, exactly. Anyways, going back to the spread, the 530, I think this is a great trade. I think that ultimately if the Fed ends up giving into Trump and other central banks giving into Trump, that the yield curves around the world will steepen. I think fundamentally,
that's the Charlie McElligott.
I'm not sure I agree with Charlie in terms of the fearing the steepener. I actually think that we might see. Yeah, and it hasn't moved as much.
It hasn't moved at all.
Yeah, and I'm not as bullish on that part of the curve because that part of the curve has to see the Fed actually like.
So this is like a second half of the year story.
Yeah. So I don't think that the 210 trade works until we get a situation where the economy really rolls over.
And then
going back to your idea about what's going to go on with bonds, I'm sympathetic to the idea that they don't go anywhere, that it frustrates both the bulls and bears for a little while as we kind of figure out what the next move is.
Yeah, for sure. I think the next, any chance, like you have to see some sort of asset deflation scenario really emerge for bonds to have their real day in the sun. And I don't think that the first half of the year has all of a lot of shit would have to go wrong in order for the first half of the year to be where everything starts happening. I think the day is coming. It's going to be a great trade, but it's just early.
Yeah. Anyways, let's move on to number one.
Number one, the markets. Did Powell, well, obviously the stock market had to react bullishly. It's just a natural function that happens when you have that kind of a dovish pivot off a Fed. But can it sustain? Like, I mean, is 2,800, 2,900 on the S&P in a straight line coming here? Or was this a fake out? And like, are we just getting a pop and is the market going to fade this? What's your intuition?
Well, first of all, I thought it was interesting that I saw all sorts of stats about how the past 5 or 6 Fed Powell meetings, the stock market was down on that news, which was very unusual. Like it was like literally there was a study about in previous kind of Fed chairmanships that how much the stock market was actually up on that day. And it had literally been 6 in a row that the stock market had been down on Powell's kind of FOMC day. And I contend that was because he was targeting financial conditions and he was purposely talking down the market. And when he did his dramatic about face and he gave up on that kind of behavior, it's not surprising that it popped. The other thing about the kind of Fed days is that often you get a situation where they're very volatile. They move up, they move down, they move up. And you very rarely do you get a trend day on a Fed day. And I was shocked that we got one on that kind of announcement. It just kind of goes to show you how dovish he really was because the market went up and it didn't give up anything.
My intuition is that Look, it's not, I actually don't believe that the next leg of the bear market is imminent. While I do think that this is a bear market, and I do believe another nasty leg of a bear market is imminent at some point in the year.
Yeah.
But
do you know what? I got to take a little pause here to give you a shout out, because you have been calling for this for a while.
Yeah.
You've been saying that, we are a ways away from the real correction, and that we could very easily get like a quarter of the stock market rally in terms of 3 months.
Well, thank you for the kudos, because I was going to reiterate that point, which is I actually think that the next couple of months we're not about to have a big crash.
Yeah.
But after one of the biggest rallies in January that we had, I mean, I know all these like pundits are out there saying that this is like the biggest January since '87. But I laugh at that shit, because you know what? Every rally is a byproduct of how bad of a kill the previous month was. Every major month that was like a record month on the upside came right after a crash the month prior.
That's right.
And so like trying to do a parade like the stock market is running like it stole something. Well, no, it's just the reaction after a massive crash.
Well, yeah, it was a function of Powell and Trump both kind of fighting to make the market go down. And so really, I look at it, to me, I think the whole move from 2640, like all those red bars, like can you just highlight them? From basically 2640 down to 23, what is that for? I think that a lot, not quite there. Like I think the market deserved to go down there. It's a little more to the right, that from this day here, and it was like there was 5 in a row. I think that was just a function of poor kind of management on both.
I think it was liquidity. I mean, it was the holiday season. Fuck.
It was made way worse. Trump was fighting with Powell in a public way, and neither one of them wanted to give in, and it just kept getting worse and worse and worse.
Anyway, the point I want to make is I just don't think that this market runs away to the upside. Like if the likelihood in my mind that after a record run in January from the lows, that somehow this thing just does this, is I don't think a realistic expectation. There's going to be a squiggle in here. The way I look at it is that it would be an incredibly natural occurrence for there to be the pullback before a rise. And so at some point, we're going to have the stock market give back. I think it's going to fade the Powell pop. It's not going to be the next leg of the bear market. It will be a buy on dip, is my view.
This is what I'm more of a positioning guy. Like I like to look around at what people are, how they're positioned. And I did know going into kind of a week ago, although I was somewhat kind of bearish and worried about the market, I was equally concerned that it seemed to be that the short-term money guys, like the fast money guys that you see that are trading it, they all were bearish.
Yeah.
I hate being
consensus.
like that.
Yeah, like that's Powell. Not Powell, sorry, Bill Farrell, where he was saying that, when everybody's in consensus, something different will happen.
Right. I'll tell you, when I write my blog pieces and everyone fights back to me, when I get the times.
Oh, yeah, you're now going to give the emperor rant?
Yeah,
where, like,
the emperor, let the hate flow through you. Yes. So I'm telling you, the best trades that I ever have is the ones where I get the biggest pushback. And people are nice. People like send me notes and they say, that's a nice thing, but you're wrong. And they tell me all the reasons I'm wrong. And I just go, that's great. And if I get a lot of those, I double up my position. And the reality is that I kind of got the sense that although I was in the consensus when I was looking for a down move, and it worried me. And I think that's part of the reason that the move after Powell was so strong,
right,
was that there was a lot of guys leaning short. And I wonder now if it could be a sell-on news event, because this was the final kind of shakeout to kind of get rid of the last of the weak shorts. And now when everyone admits that there's no reason for it to go down, it goes down. That's kind of what I'm thinking.
We're overdue. It would be a very natural thing. Let's see if that plays out. Anyway, let's move on. Kev, you put together a little parting words of wisdom. Why don't you share with our listeners what wisdom you want to share?
I don't know how much of a good trader Benjamin Graham was, but I thought this was a great kind of line. He says, the intelligent investor is a realist who buys from the pessimist and sells it to the optimist. And I just thought, I thought it was a great, I hear he really, tossed a big line in the spooze pit, but I'm not sure about Benjamin Graham.
Well, he wrote a few books that I think were kind of popular, right?
Yeah, that's right.
All right, let's move on.
Okay, well, that's it, Patrick. Any parting words in terms of what you think of the beer?
It grew on me. I continue to enjoy it. I actually would recommend this. Try out the Smash Bomb Atomic IPA. If it's good enough for Powell, it's good enough for me.
So, this might be the first sponsor that we actually get back because Patrick doesn't shit all over them. and just so we know, Tony, if you're listening, your record still stands.
I have not.
I think that's going to stand for a long time because don't forget it's only half a show. So I don't know how anyone's going to ever be.
Oh, that would mean, but okay. Now I don't think he was drinking Tall Boys because we always drink the 500 ml Tall Boys. Right?
You're right. And so,
I'm pretty sure he was cracking the 300 mils.
And at the risk of kind of alienating our American audience, it was American beer.
No. But it was craft beer, so let's give him that.
Oh, it was real beer. It wasn't like Schlitz or whatever it was, which isn't a beer; it's a diuretic. Okay, let's get to it. Thanks for spending some time with us. Please visit our site at markethuddle.com to sign up to receive our weekly email that will include a link to the show and the charts that we discuss. Rest assured, we will never clog your email with junk, and we will only send you our weekly letter and updates for the upcoming shows. Patrick, that's when you come in.
That's when I'm supposed to come in. All right, so please follow our Twitter account at The Market Huddle, as well as you can follow Kevin at Kevin Muir and myself at Patrick Ceresna. So if you're watching this on YouTube, make sure you hit the subscribe button, and if you like it, make sure you leave a comment and let us know. Otherwise,
if you don't like it, don't say anything.
Don't say anything if you don't like the show.
Yeah.
Anyway, thanks everyone for joining us, and we've got many great episodes coming up. We are lining up a few other little surprise guests in the coming weeks, so make sure you stay tuned to see who we got in the hopper. Anyway, thanks everyone for joining us. On behalf of Patrick, thank you.
And this is Kevin signing off. Have a great week trading, everyone. Thanks a lot.